All right, last screencast in this dense unit, screencast number 6, land and capital. So this is a unit about the resource market, and there are 4 kinds of resources: labor, entrepreneurial ability, land, and capital. And as we learned in the very first unit of microeconomics, each of those resources gets a payment. So the payment for labor we call wages, payment for entrepreneurial ability, profits and losses, the payment for land we call rent, payment for capital we call interest. Now, we've focused on a few of these resources already, and mostly we've been focusing on labor and how wages get determined. We've also indirectly focused on entrepreneurial ability when we were talking about product markets in terms of profits and losses. All of those rectangles of profits and losses we saw in perfect competition and monopoly and monopolistic competition. That's essentially what the entrepreneur gets. They get the wins or the losses of the business that they're operating in. What we haven't focused on yet are land or capital, and that's what we're going to focus on in this screencast. So we're going to start with land. Now, the payment for land is rent, and the word rent has a very specific meaning in economics. The word rent means a payment above and beyond that necessary to produce the good or service in the first place. So for example, if you're making lemonade and it costs you $2 to produce a glass of lemonade, including normal profits, including the cost of whatever else you could be doing instead of making lemonade, then any payment in excess of $2 that you get for that glass of lemonade, we would call rent. You could think of it kind of as like an unnecessary payment, like a payment not necessary to incentivize you to produce the lemonade, right? It's just like extra money to you. So any payment for land, we're going to consider rent under this definition because land's already been produced. It was produced however many billions of years ago. If no one offered any payment for land, land would still exist. And that's why we call the payment for land rent, because it's kind of like an unnecessary payment. No one needs to be incentivized to produce land because it's already there. So the key to the graph for land is this idea that there's this fixed quantity of land. In other words, there's a perfectly inelastic supply of land. There's X amount of acres of land in the world, and that's pretty much it. Now, people will tell you that it's possible to create new land. And if you go to the Middle East, they've actually created islands in the shapes of things. Where I lived in New York City a number of years back, they bulldozed all this garbage into the Hudson River and paved over it and created more land. Or maybe you can view skyscrapers as kind of a way of creating more land vertically. I mean, those are true on the margin, but it's basically perfectly inelastic. I mean, for all intents and purposes, we have X amount of land in the world. So we're going to be dealing with a perfectly inelastic supply of land. What that means is that what determines the rent for land isn't going to be supply, since that's pretty much fixed. It's going to be demand. If demand is relatively high, like let's say in New York City where everyone wants to live, then rent is going to be relatively high as well. If demand is lower, like maybe in New Jersey, rent is going to be lower as well. Right? It's that demand curve that's determining the rent, because that supply curve is perfectly vertical, perfectly inelastic, and isn't moving anywhere. So if we were talking about now North Dakota, where the demand might be even less, you pay even less rent. I mean, this kind of explains why I was paying like $2,000 for a 1-bedroom apartment in New York City, and why you can get an apartment in North Dakota for like $14. And if demand was even lower, like maybe in Arkansas, you might have a situation that looks like this, where no one wants to live there. And if demand is low enough, land is said to be a free good, commanding no rent. I mean, this is kind of why, if you know US history, the government was paying people to move west. There was a certain supply of land there, but the demand was so low that people weren't willing to pay to be there. You actually had to pay people to get people to move west. All right, so much for land. Pretty simple. Next, let's talk about capital. Remember what capital is. It's goods or services used by a business in order to produce other goods or services. So things like tools, machinery, equipment, robots, that kind of stuff, that's capital. Going back to the little chart, you'll notice that the payment for capital is interest. Now, before I get to why exactly that is, it's important that you understand what interest is. I'm hoping you already do. Interest is the price you pay to use somebody else's money. So for example, when you take out a loan from a bank, you pay interest. You're using the bank's money for a certain amount of time, and interest is the price you pay to use their money. Or when you open a savings account, it's working in the opposite way. You're giving your money to the bank and they're paying you interest because they get to use your money for a certain amount of time. Now, interest is, is typically stated as a percentage, 4% interest, 10% interest, what have you. And depending on the situation, we can consider interest to be either an explicit cost or an implicit cost. And I'll come back to that in a minute. All right, so fine. But why is the payment for capital called interest? Why is interest the payment for capital? Doesn't really seem to make intuitive sense. Let me talk about why the interest rate matters. Let's say you run a business and you're thinking about buying a new machine. That's capital. That will help you produce. And let's say that machine costs $200, and to keep things simple, let's assume that that machine has a useful life of 1 year, which means that the machine will last for a year and then it'll just go away, it'll implode. You get to use this machine for a year. I'm doing this just to simplify this example. Let's also say that you calculate that if you were to buy this machine, your revenue for the year would increase by $220. So the machine costs $200, but if you buy it at the end of the year, you'll see $220 more in your cash register. All right, and you're thinking about whether or not you want to buy this machine. First, what you need to do is calculate what's called the rate of return on that machine, and it's stated as a percentage. The formula for rate of return is the increase in revenue minus the initial cost of the machine divided by the initial cost of the machine times 100. So in our example, the increase in revenue is 220, the initial cost of the machine is 200, divide that by the initial cost of 200 and multiply that by 100. What that gives you is 10%. In other words, you're making $20 profit essentially on your $200 investment, a 10% rate of return. So far so good. Machine seems like it's a win. But let me pose this possibility to you. Let's say that there's a bank down your street. And suppose that that bank is offering a 14% interest rate for savings deposits. The bank is saying, hey, come put your money here and we'll pay you 14% interest. Let's say that also that bank is offering loans to make loans at the same interest rate, 14% interest rate. So you can put your money in the bank and earn 14% interest, or you can borrow money from the bank and pay them 14% interest. Can you see why the interest rate matters in terms of whether you decide whether or not to buy this machine? Let's say you don't have the money to buy the machine. Let's say you look in your pocket and there's nothing in your pocket. So for you to buy this machine, you would have to go out and take out a loan. You would have to borrow money, $200, and pay the bank 14% interest to borrow the money. In this case, interest is an explicit cost. You will eventually have to take 14% interest out of your pocket and hand it back to the bank at the end of that loan. Now, even if you have the money, let's say you have $200 in your pocket, that interest rate still matters because it's an implicit cost. You could take your $200 and buy the machine, or alternatively, you can walk down to the bank, put $200 in a savings account, and earn 14% interest. So buying that machine has an opportunity cost. Buying that machine means that you can't be putting your money into that bank and earning 14% interest. In other words, in this example, either way, whether you have the money or not, you have to think about that interest rate either as an explicit cost if you're borrowing the money, or an implicit cost if you would instead put your money and open up a savings account in that bank. So really, this is just yet another marginal benefit, marginal cost situation. From the very beginning of the year, the rule is do whatever, as long as the marginal benefit is greater than or equal to the marginal cost. And in this case, the marginal benefit is the rate of return of the machine, that 10% earnings you're going to make on that machine. And the marginal cost in this sense is the interest rate, either as an explicit or an implicit cost. So in our example, the marginal benefit of buying the machine would be a 10% rate of return, but the marginal cost, whether you have it or not, the money or not, is 14%. In this situation, you would not buy the machine. You're comparing the rate of return to the prevailing interest rate, and if the rate of return isn't as high as the interest rate, you should not buy that machine. You should either not borrow the money from the bank, or if you have the money, you should just put the money into the bank and open up a savings account and make more than the machine's going to make for you. All right, so finally, what is it that determines the interest rate? Why was the interest rate 14% and not 9 or 12 or 100? Well, shockingly, it is about supply and demand again, and in this case, the supply and demand for money. Now, the supply of money comes from people's deposits in banks. That's where people get money. They get money by borrowing money from banks, and where banks get money is by people opening up savings accounts and putting money in their vaults. The demand for money comes from people who want to borrow money, who demand money. That might be a business who's thinking about buying a machine. It might be you who are thinking about going to college and maybe you need to take out a loan. Or maybe you want to buy a car and you need to borrow money to buy a car. So we're going to represent this graphically in what's called the Loanable Funds Graph, or sometimes called the Loanable Funds Market, which is going to show up a lot more when we get to macroeconomics, but it does pop up now and again on the microeconomics exam as well, which is why we're going over it. So just as an initial view, and we'll get a little bit deeper into it in the second semester of the course, here's what the loanable funds graph looks like. Here's the supply of money. On the vertical axis, we have the interest rate. And notice that as the interest rate goes up, so does the supply of money. As banks offer higher interest rates for savings accounts, 1%, 2%, 4%, 100%, we put more money into banks. Here's what the demand for money looks like. It's downward sloping. When the interest rate is really high, when it costs a lot to borrow money, we don't borrow that much. And when the interest rate is low, when it doesn't cost that much to borrow money, we borrow more. Again, if we let things go to equilibrium, the market's going to determine the quantity of money borrowed and lent out, and it's also going to determine the interest rate, wherever supply and demand meet. If the supply of money were to increase, you can predict what would happen to the interest rate. Or if the demand for money were to increase, you could also predict what would happen to the interest rate. Okay, kind of an abstract note to leave this unit on. It's been a dense unit, I will admit that. The screencasts have been longer than normal. In some sense, I apologize, I guess, for that, but I want you to have every piece of information you need to do well. All right, that is it. I will see you next time, and that'll be the very last unit, shedding a tear.
Honey, or let's go play.
I don't feel like it.
Why are you always in such a bad mood?
I have a nail in my anus.
Oh.